All right, let's just jump right in. The stock market. For so many of us, especially when you're just getting a handle on your finances, it can feel like this super complicated world, right? Like it's only for the pros on Wall Street.
And that's kind of how it's portrayed a lot of the time, isn't it? As this big, scary abyss. The idea that if you don't know exactly what you're doing, you're just going to lose all your money. And honestly, that fear makes total sense.
But is it really that complicated? What if the basic ideas behind it all are actually way, way simpler than you've been led to believe? That's what we're going to do here. We're going to break it all down and show you the simple logic that's really running the whole show.
Okay, so first things first, we have to tackle the biggest, most basic question of all. What in the world is a stock? Because it's definitely not just some random number blinking on a screen. A stock, or you might hear it called a share, is, well, it's pretty much exactly what it sounds like. It's a share of a company. When you buy a stock, you're buying a tiny, tiny piece of that business. No joke, you literally become a part owner.
Let's use an example to make this super clear. Think about a giant company like Amazon. Now just imagine for a second they only had 1,000 shares in total. If you went out and bought just one of those shares, you would own 1,000th of the entire company. Now obviously in the real world they have billions of shares, but the idea is exactly the same. Your stock is your little slice of the whole pie.
And that ownership, it kind of comes in two main flavors. You've got common stock. With that, you actually get a say. You get to vote on big company stuff, like who gets elected to the board. Then there's preferred stock. With this one, you usually give up your voting rights, but you get a pretty cool perk instead. You're first in line to get paid dividends, which is just a fancy word for a piece of the company's profits.
Which brings up a really good question, doesn't it? Why would a company, especially a successful one, want to sell off little pieces of itself to people like you and me?
Well, the answer is actually pretty simple. Money. By selling stock, a company can raise a massive amount of cash, capital, to do things like build new factories, hire more engineers, or expand into new countries. It's basically a way to fund their big dreams, all based on what investors think they could become in the future.
Okay, so we get it. Companies sell stock to get cash. But how does that connect to the part we always hear about? The prices going up and down all day long? Well, it's not some crazy mystery. It all comes down to one of the oldest rules in the book.
Think about it like this. Let's say you're selling an old video game console on Craigslist, and you list it for $100. The second you hit post, your phone just explodes with messages. 100 people all wanting to buy it right now. What's the first thing you're going to think? Whoa, I definitely priced this way too low. So what do? You start raising the price, right? Until all that crazy demand simmers down, and you're left with just one serious buyer. And boom, you've just found the real market price.
And believe it or not, that's basically how the stock market works. It's not some guy in a suit deciding, I think I'll raise the price today. Nope, it's the combined result of millions and millions of people buying and selling, all at once.
So here's the bottom line, the absolute key to it all, supply and demand. If way more people want to buy a stock than sell it, that high demand pushes the price up. And on the flip side, if everyone's trying to sell and not many people are buying, you've got a surplus and the price goes down. That's it. That's the engine driving everything.
All right, so we know what a stock is and we know what makes the prices move. But so what? Why should you even care? Why not just stash your money in a savings account where it's safe?
Well, this chart right here really tells the story. A high-yield savings account in a really good year might get you, 2, maybe 3%? That's okay. But when you invest in companies that are growing, the potential for returns is just in a different league. We're talking about the kind of growth that can actually beat inflation and build some serious wealth over the long run.
Let's put some real numbers to this. A famous example. Let's go back in time to 1997. Imagine you saw some potential in this new thing called online shopping, and you decided to invest just $1,000 into a tiny online bookstore, a little company called Amazon.
So what would that $1,000 bet be worth today? Roughly $1.5 million. Now, let's be super clear. That is a massive, once-in-a-generational example. It's a total outlier. But it perfectly shows the incredible, life-changing potential of investing in a great business and just letting it grow.
So, okay, the potential is obviously huge. You get the basics, but how do you actually go from knowing about this to doing it? Well, the great news is that getting started is easier today than it has ever been.
Here's the 4-step playbook. It's pretty straightforward. First, you open a trading account, sometimes called a brokerage account. There are tons of them, like E-Trade or apps like Robinhood. Step 2, and this is probably the most important rule of all, You fund it with money that you are genuinely okay with risking. Don't invest your rent money. Then, the fun part, you start researching companies that you actually understand and believe in. And finally, you pull the trigger. You buy your first stock. That's it. You're officially an investor.
So you see, the stock market isn't some big, scary monster. It's just a place where you can own a piece of the companies that you believe are building our future. You've got the basics down now. The foundation is there. So the only real question left is, what's your first move going to be?